De-dollarization continues. Foreign officials are slamming the brakes on U.S. debt purchases and deleveraging dollar exposure up again, even from last month. Today, we're breaking down the latest TIC data for July 2025, released just yesterday. Foreigners buying of U.S. securities, it's slamming on the brakes, and that's across the board for private and official institutions. So before we get into the TIC data, and there's a bunch of really interesting data in there, we have to set a couple key pieces of context for the discussion. De-dollarization is a very heated debate. People get very hyperbolic about it, make all sorts of extraordinary claims like you will just wake up one day and the dollar will be worthless toilet paper and no one will use it. That is not how these things play out. They take many years, if not decades, to play out. Number one. Number two, it already started. In fact, it's already been in place for arguably 12 years at least, as we will see from some of the charts. It already started. Point number two. Point number three, when people talk about the dollar as reserve currency, they are mainly talking about the dollar, the global reserve asset. And what that has been historically was the U.S. Treasury, the U.S. government debt. That was the global reserve asset. Remember, if you're a current account surplus, a trade surplus like China or Japan, for example, on a net basis, every year, capital's flowing into your country. You need a way to store the value that is flowing in, a way to save that money. Well, historically, U.S. Treasuries were a good way to do that for two reasons. Number one, when you own a U.S. Treasury, you are owning a dollar denominated asset. So you are already long on the dollar. Well, the dollar, generally speaking, strengthens against most currencies. So you're making money, you're storing value that way. Well, you're also getting interest. So you're also earning interest in dollars, which again, the dollar is appreciating versus other currencies. So historically, this was a good way to store value. We will see that some of those trends started to change over the past decade or two. But that is really what we're talking about. Yes, there is the unit of account, right? Like the petrodollar, oil is transacted in dollars. That is part of it. But arguably, the most important way to think about the dollar reserve currency sort of concept is through the lens of U.S. government debt. A U.S. Treasury, a government bond, is just an interest-bearing dollar with a maturity, with an expiration to it, where you get paid your principal back. You are long the dollar when you hold a U.S. Treasury. That dollar is appreciating versus most other currencies, generally speaking, and you're earning interest in dollars. So again, if we look at foreign held debt just on its own, it's up and to the right, 9.1 trillion. Looks like the dollar and the U.S. Government bond is rising. Well, you have to look at it in context. So here is that foreign held debt as a share of total U.S. government debt. This peaked 13 years ago and has been declining for over a decade, from 35% down to just 25%. So again, these things already have been in place and most people didn't even realize. So here is a chart from the IMF, the International Monetary Fund, showing again dollar share of FX reserves been in decline for 25 years. Here is yet another. And here is a really good chart that shows the big picture here of this kind of global savings or this global international reserves. And historically, this was mostly gold. 90% of these global savings were in gold. However, after World War II, you can see that gold share fell from between 70 and 90%, somewhere in there. We don't have data for World War II, but fell from, call it 80%, all the way through up until the GFC. It fell down to just about 10%. Well, what was taking its place? It was the dollar, seen here in red. So the gold was losing ground and the dollar was gaining ground. Again, remember, this means U.S. Treasury, generally speaking. Interest-bearing dollar, a dollar-denominated asset. However, around 2010, we can see a shift where gold starts to increase in terms of its share of global savings, global FX reserves. And what is it eating out share from? It is eating out from the dollar. So we can see the dollar started to decline around 2010, again, in line with the data we were just looking at here in TradingView. So arguably, if you use IMF data, this has already been in place for 20 years. If you look at this data, it's been in place for at least a decade, and is generally a story of, again, U.S. Treasuries, U.S. government bonds. That is really what we're talking about here. So here's the TIC data, cross-border capital flows This is in billions of dollars and is not seasonally adjusted. So, a couple key points that I've highlighted. We'll go through this very quickly. So, $78 billion dollars for the month of July. Remember, this is lagged by about 2 months. Unfortunately, it is what it is. For the month of July, $78 billion dollars on net foreigners purchased of US securities. So, this looks good. It sounds good. And again, this takes the difference between gross sale of US securities and then how much of those US securities were bought by Americans, takes the difference. And that tells you how much securities were bought by foreigners. They bought $78.8 billion dollars of US securities. That sounds great. That's a lot of money. However, look at the trend. So May, that was 326 billion. In June, it was 192 billion. So this is decreasing. Of course, April, we saw a net selling of US assets. That is the Liberation Day chaos around when we started the channel and had that video, who's dumping US Treasury bonds. Well, we can see it here in April. There was a lot of selling of US assets. On a net basis, they were still purchasing of domestic US securities. However, it is decreasing. So it is falling from 326 billion to 192 down to 78. Now, breaking this down a little bit further, remember, private institutions, this includes hedge funds that are in a tax haven like the Cayman Islands or Ireland or Luxembourg. That includes hedge funds. So this can also include, of course, private individuals, just a household in Germany that would like to buy some US government bonds. It can include individuals as well, but this also includes, of course, hedge funds, some of which are US firms. They're just based out of other countries. So that's important context as we look through this data. They purchase, private institutions purchase 72.4 billion in total, including 41 billion of treasury bonds and notes. However, again, remember, there's a big difference between a price insensitive bidder like, say, China or Japan, that is bidding your debt. Again, price insensitive. They just have to buy your debt to balance that current account deficit. They just have to buy it. Doesn't really matter the price. And they're not going to be inclined to just sell it, right? They run a current account surplus. So they, and generally speaking, not a very large fiscal deficit. So they are not ever put into a position where they must sell to raise cash to cover a deficit. However, what have we seen over recently? The UK has become, of course, Japan is it's still not that spot as a current account surplus country. However, we have seen the UK become the second largest holder of US government debt, and they run a massive twin deficit. They are in arguably the midst of a debt crisis. That is the exact opposite of who you want holding your debt. You want strong countries with current account surplus like China, like Japan, price insensitive. That is who you want to be holding your debt, not twin deficit countries like the UK or fast money hedge funds that are levering up 20 to 1 and could get a margin call and be forced to sell your debt. So, a couple really key points here. It matters not just how much debt is being bought, but it matters who is buying it. So, again, on a net basis, equities, private institutions, foreign private institutions, they had been loading up on US equities, US stocks, $100 billion for the month of May and June. This has actually turned into an outflow. So they were on net selling US stocks $6 billion. Now, if we go down to official institutions, again, this is thinking more in terms of FX reserves and global governments and central banks and sovereigns, what we can see is for the 12 months through July 2025, so July 24 through July 25, holdings of overall U.S. securities have fallen by $54 billion. And specifically for U.S. Treasuries, for U.S. government debt, this has fallen by $25.2 billion. For the 12 months from July 24 through July 25, $54 billion decrease. Again, that price insensitive sovereign, they are stepping away clearly. I mean, even the private institutions are massively decreasing. They're still on a net basis purchasing US securities, but the amount is going down significantly from May to June to July, as we can see there. Official institutions bought $17 billion of treasury bonds and notes. There's a lot more volatility here, but Generally speaking, that is why I highlighted this 12-month period. Is this kind of sorts through some of that volatility month to month, shows the bigger picture on once you zoom out the 12 months up through July 25. Official institutions, governments, central banks, sovereigns are selling U.S. Treasury bonds on a net basis. Yes, they might be purchasing some, but on a net basis, they are selling by $25 billion for that 12-month period. Also, we saw foreign official institutions had loaded up on US stocks for the month of June. This also turned into a net outflow. So, on a net basis, both the private institutions were selling US stocks in July, as were official institutions. And here, the space between the yellow lines is the month of July that we are looking at. Here are a couple stock indices. Most indices grinded higher for the month of July. There was a dip towards the last month, or excuse me, the last week of July. We can see that here with the U.S. Indices, S&P, NASDAQ, Russell, and Dow. Same general trend, gradually higher. However, there was a brief pullback in the last week of July. We don't know when the selling occurred, but that is just some context for how equity indices were doing overall. So here we're going to go down the blue box. What this is talking about is how much what are Americans doing when it comes to foreign bonds, foreign equities? Are we as Americans buying foreign stocks? Are we buying the DAX? Are we buying the CAC? And are we buying boons and gilts, right? Foreign debt instruments. So what we can see is that, again, a negative a reading here indicates a capital outflow, as the footnote here tells you. We, on a net basis, bought $22 billion of foreign equities, and looking at bonds, we bought about $7.4 billion of foreign bonds. So on a net basis, again, that is generally how, at least when it comes to equities, and we'll take a look here at various currencies. It's also important to see how those were doing for the month of July. The dollar strengthened versus the yen, and here the dollar also strengthened versus the euro. However, they are both part of a larger trend, which is dollar weakness for this year. Here is the global 30-year yield. So we're looking at German 30-year yields, French, British, Japanese, JGB, and the US 30-year yield here in white. So this is a picture of kind of the yield curve overall. And here is, of course, the US yield curve. Again, for the month of July, most of our yields were flat. Of course, the Fed was keeping rates constant. However, I will point this dip here in the 3-month yield. Again, what that means is that there was a brief amount of buying of a treasury bills, short-term U.S. Government debt instruments, but generally speaking, and that was on Fed rate cut expectations with weak payrolls and labor market data. But generally speaking, most bond yields were flat for the month of July. Now, moving a little bit further down, we can see that on a net basis, U.S. residents bought about $29 billion of foreign securities. And of course, going up here, foreigners bought $78 billion of U.S. securities. So if you take the difference between those, that represents a difference of about $49 billion, which we see right here. What this means is that there were more purchases of U.S. assets from foreigners purchasing U.S. assets than there were of Americans buying foreign assets. But again, this is slowing very, very significantly over the past couple months. So from May, it was 266 billion. June, it was 151 billion. And this month, for the month of July, it was only 49 billion. Now, Treasury bill holdings decreased by 2 billion. We can see that there. These are short-term debt instruments, this section. And this was driven mainly by the private holdings dropping by about 9 billion. And so maybe there was some selling by private institutions. Again, remember, hedge funds are included in that. Maybe there was some selling there on rate cut bets. Not really sure. We won't ever know for certain, but there was a decrease there of private holdings of U.S. Treasury bills by 9.1 billion, and an increase, if you look at official holdings, of 7 billion. Now, finally, to finish up here, the bottom box. This is really interesting because, again, it lines up with what we saw last month. the change in banks' net dollar denominated liabilities decreased by $61 billion for the month of July. This is an even larger decrease from last month, which was already notable, $46 billion. So, for those that are aware of the dollar milkshake theory, this kind of ties into some of that. So, and maybe as a counterpoint, but this ties into that concept of kind of the Eurodollar system, dollar denominated liabilities. Well, what we see is again an even larger decrease in dollar denominated liabilities, even than last month, which was already quite large, of $46 billion. So, what this means is that in general, foreign residents were basically decreasing, whether that's foreign people, individuals, companies, governments, they have some dollars in US banks. And, this could be a deposit or a short term loan, something like that. So, a decrease in these dollar denominated liabilities, what that means is that foreigners are pulling out that money or paying down, in the case of a loan, paying down what they owe so that there are less dollars flowing into or staying in US banks from abroad. So, this is that kind of this is what you would see with a capital repatriation to some degree. You would see a net decrease in liabilities. And again, generally speaking, the dollar milkshake theory assumes that there would not be an asset that could delever. Again, there are certainly a lot of Eurodollar debts, dollar denominated debts that foreigners have. However, if there is an asset that comes around like gold, which has doubled over the past couple years, then those dollar denominated debts. Now, remember, the dollar has also weakened versus pretty much every major currency for this year by about 12% on the DXY index. So, not only has the dollar weakened relative to other currencies, but you also have gold appreciating. So theoretically, it's really hard to tell to what degree what degree this is actually happening. But just theoretically speaking, all those dollar denominated debts could be delevered by both forces. So number one, the dollar is weakening relative to other currencies. So again, if you're in Europe and you have a dollar denominated debt, well, as the dollar falls against the euro, because you're earning income in euros, your purchasing power is going up. So if anything, your debt is getting less onerous. It is getting easier for you to service that dollar denominated debt that you might have because again, the dollar is weakening versus the currency that you are earning your income in. Then once you start to include gold into that, where gold has appreciated versus the dollar, then you could have really a kind of a double whammy where yes, foreigners do have a lot of dollar denominated debts, but what we have seen from the TIC data is that there was a significant decrease here for the month of June, and an even larger decrease for the month of July. And this was, as we can see, private versus official. It was mainly driven by official holdings, which were decreased by 20.5 billion. Now, private dollar denominated inflows increased by 22 billion. However, official decreased by 20.5 billion. So on a net basis for the month of July, the net dollar denominated portfolio inflows were $2.1 billion. So again, the dollar milkshake theory is correct in that it accurately talks about the Eurodollar system, but to the degree that there are assets, to the degree that the dollar can weaken versus pretty much every major currency, as we have seen for this year, DXY is down about 11%. Number one, number two, if there is an asset that comes around that can also further deleverage those dollar debts, like gold, for example, which is going parabolic, then all those foreigners that have dollar denominated debts, that dollar denominated debt is not getting more onerous. They are not being squeezed on dollars. In fact, the more time they wait out, the smaller and smaller and smaller that US dollar denominated debt becomes. Hopefully that makes sense. And here again is the 30-year yields. We can see that the issues, by the way, for Great Britain, rates are back on the move upward again. We did have a bit of a bull flattener here in the US as well. But again, that is pretty much over. We can see the curve is starting to steepen again. The Fed cut rates a couple days ago. And what have rates done? They've only gone up. So this is identical to what happened back in September, which happened to be the bottom in the 30-year yield, the 10-year yield. So we're continuing to see pressures on kind of sovereign debt, at least developed market sovereign debt. And we'll continue to watch that. If anything develops in the UK or France, which, of course, in Japan, there was some announcements overnight. Inflation data actually came in cooler than expected. And so, despite that, though, you have the 2-year JGB yield, 5-year JGB yield. Those are both hitting 14-year highs. And of course, the long end of the yield curve, that is actually catching a bit of a bid. Those long-term bonds, the 30 and the 40-year JGBs, those are catching a bit of a bid, and yields are actually down a bit. You also had the Bank of Japan come out, announce some asset sales, balance sheet contraction. So we'll continue to watch that. We'll continue to watch France. We'll continue to watch the UK. But the tick data, again, generally shows kind of a worrying sign for the US, which is generally speaking, right? There are still, on a net basis, purchases of US securities. However, again, it matters who it is that is buying it. Is it some fast money levered hedge fund, levered 20-1 that might face a margin call and have to sell your debt in a panic? Or is it a price insensitive foreign government, right? Which you see in the official holdings. Those are slowing way down. I mean, it's even the private purchases are slowing way down, 294 to 154 to 72. This is slowing down across the board, whether it's private or official. And again, Americans continue to buy foreign stocks. So again, this goes into the kind of outperformance theme that a lot of people are talking about, where foreign markets, many investors are betting that foreign markets will outperform the U.S. We'll continue to watch that. If the dollar continues to weaken, that would generally, because again, remember, if the S&P 500 is up 10% this year, but the dollar is down 11%, then the S&P 500 is not really doing well in the overall scheme of things from a kind of global market standpoint, from a global macro standpoint. Yes, for an American, your stock portfolio might be up 10%, but again, the DXY is down 11%. So overall, the S&P is really not doing as well as it would look at first glance. So we'll continue to watch this. There is definitely foreign purchases of both bonds and foreign equities as well. And there is a strong degree of outperformance in various markets above and beyond that in the U.S. So we'll continue to watch that, continue to watch the yield curve. Again, the month of July was not super interesting for yields. Yields were basically flat pretty much across the curve, and the curve didn't really do much during the month of July, steepened but then flattened, basically sideways for the month of July. So anyways, hopefully this was helpful. I will link this report in the description. So if you would like to read through it and maybe make your own notations, you can do that. Hopefully this was helpful, and I'll catch you in the next one.